just as a bit of background on Debtwire, we're a fixed income news service, as Matthew said. We have offices based all around the world. I'm based in London. And my coverage tends to be focused on early stage origination opportunities in the debt market across bonds, sukuk, project finance and syndicated loans, as well as covering deal previews on upcoming bond and sukuk issuance. So I'm going to give a quick rundown of the major deals that we've been covering in the Saudi loan and sukuk market so far this year, before talking a little bit about the macro situation and our expectations for the debt market going forward. Our analysis of 31 major deals completed in 2015 so far, and that excludes the sovereign issuance, we'll come on to that a bit later, shows that total debt issuance in Saudi across both loans and debt capital markets was $32.4 billion equivalent. And on the slide behind me, you can see the breakdown between corporate loans, sukuk, and project finance for that total. So the sukuk market continues to be dominated by local currency deals of $5.9 billion worth of sukuk issued by Saudi Arabian-based entities. $4.4 billion of that has been denominated in Saudi riyals. According to data from Reuters, sukuk issuance in 2014 totaled $7.8 billion equivalent. So the gap between this year and last year may narrow a little bit before the end of the year, but I suspect that there'll be overall a slight decrease in issuance for 2015. So starting then with the 1.5 billion worth of US dollar denominated cross-border activity that we've seen so far this year, it's been limited to supranationals, so not pure Saudi credit. The 1.5 billion came from two deals. The first one was placed by the Islamic Development Bank in March with a 1 billion 5-year sukuk. And then that was followed up by Apicorp in October, which priced a $500 million 5-year sukuk. And they achieved quite a tight pricing on this of 100 bips over mid-swaps, despite the challenging environment that we're kind of entering into. So just going forward to look at cross-border deals, dollar-denominated deals in the pipeline at the moment, there's been some speculation that the Islamic Development Bank will return to the market following a $10 billion increase in their issuance program in June, which brings their program to $25 billion in total. Meanwhile, the Islamic Development Bank's private sector arm, the Islamic Corporation for the Development of the Private Sector, are also reportedly working on a smaller dollar-denominated issuance before the end of the year. Moving away from the supranationals, though, and to look at some kind of pure Saudi credits, we're seeing in the pipeline the quasi-sovereign Saudi Electricity Company has announced the establishment of a $1.5 billion sukuk program, and Saudi British Bank is also understood to be in the pipeline with a dollar-denominated deal. But I think with the window to issue closing as we near the end of the year, I think deals would need to come quite soon if they want the deals to materialize this year. And that's not to mention that issuers may hold fire until after any possible sovereign cross-border deal has happened. So moving over now to the local currency side of things, I think probably the most notable theme we've seen in the Saudi market, sukuk market, as with all markets, has been financial institutions preparing for Basel III implementation by issuing capital-friendly Tier 1 and Tier 2 instruments. So far, National Commercial Bank is the only lender to have issued a Tier 1 sukuk, having placed a 1 billion Saudi riyal note in June. But Riyadh Bank, Saudi British Bank, and most recently Arab National Bank have all placed Tier 2 sukuk also. So on the corporate front, in terms of deals we've seen materializing so far this year, Al Marai closed a 1.6 billion Saudi riyal 7-year sukuk in September, and Najran Cement a 400 million 5-year sukuk in June, and then most recently Bari, the national shipping company, a 3.9 billion Saudi riyal sukuk in July. And in the local currency pipeline, we're seeing Ma'aden Phosphate expected to tap the local currency market alongside their planned corporate loan. So moving on now in terms of the loan market, issuance so far this year has totaled 26.5 billion US dollars equivalent, according to our data. The lion's share of this came from a jumbo $10 billion four-tranche revolving credit facility that Saudi Aramco secured in March, which was split 3 billion in Saudi riyals, the remainder in dollars. In terms of other major deals contributing to the loan total, we've seen project finance deals also contributing significantly, with a $5.2 billion finance package for the Petro Rabic 2 IPP, as well as the Aqua Power and Air Products and Chemicals JV, their Jazan City project, signing a $1.7 billion equivalent loan earlier in the year. In terms of corporate loans, local currency corporate loans, we've seen a couple of big deals. The Saudi Bin Laden Group with 6.2 billion Saudi Riyal 7-year syndicated loan, and most recently the Jabal Umar Development Company with an 8 billion Saudi Riyal 12-year Islamic loan. So according to our data, 52% of loan debt so far in 2015 has been denominated in Saudi riyals, and that's totaling $13.9 billion equivalent. And that compares to $12.6 billion in US dollar denominated debt. So I don't want to kind of make too much of a case for there being a shift in the market, given that the US dollar denominated debt comes from two jumbo deals, the Petro Rabic deal and the Aramco deal. However, there was a report a month or so ago in Bloomberg suggesting that only $1.7 billion of dollar-denominated debt was signed in 2014. So that would suggest that there has been something of a shift in the market this year, which would make sense given tightening local liquidity and the rising Saudi interbank rate. So looking forward in the pipeline for US dollar-denominated debt, I think we'll see project finance continuing to play a significant role. The Fadali IPP is expected to come to the market for a power plant that industry sources suggest could cost between $1.25 and $1.5 billion. The Saudi Bin Laden Group was understood to be contemplating a 5-year US dollar loan, and SABIC will also likely come to the market soon with a $2 billion 5-year loan. And the Ma'aden Phosphate Company and Saudi Electricity, who are also in the market for sukuk, are also understood to be in the market for mixed currency loans at the same time. So that's just a bit of a blast through the specific names that we've been covering and reporting on so far this year. But to turn now to look a little bit at the broader issues that we're seeing. I mean, a number of trends have emerged in the Saudi debt market in 2015, so far related to the commodity price slump, the sovereign downgrade, the newly established sovereign issuance program, and changes to the global regulatory framework. So the sharp fall in oil prices has created significant budgetary pressure in the kingdom. And in order to finance the deficit, Saudi Arabia has dipped into its holdings at the central bank and turned to the debt market for the first time since 2007. And just to pause for a moment on the issue of the foreign currency reserves, which I think it's fair to say that the headlines haven't been hugely favorable. This is a selection of headlines from the UK press. And while the sovereign has been burning through cash reserves since the start of the year, I think it's worth putting into a bit of historical context. I think, as you can see, foreign reserves were at a high in 2014, and I think there's still a healthy cushion there left to fall. And that's not to mention that Saudi is virtually debt-free, which allows plenty of headroom to finance the deficit through debt. You can see in this slide a comparison of Saudi Arabia's debt to GDP ratio against a selection of other A+ rated countries. And on this one, their net debt to GDP ratio against the same countries. So yeah, again, I think there's plenty of headroom there for debt issuance to finance the deficit. And I think coupled with fiscal consolidation efforts, spending cuts, project postponements, and the possibility of introducing taxes, Standard & Poor's certainly believes the government deficit will peak in 2015 before falling down to 5% in 2018. And I suspect that the size and the speed of the swing to a 16% deficit in 2015 from the 1.5% deficit in 2014 was the key driver behind the downgrade, rather than the fundamentals having turned particularly sour. And just in terms of the fiscal consolidation, I was seeing the report just a couple of days ago about the airport privatizations potentially going ahead. So I think the fiscal consolidation process may well be already underway. But I don't want to get too bogged down in the macro side of things. I'm not an economist, and there are people in the room far more qualified than myself to speak on that subject. So I suppose I'm more interested to look at what this actually means for the debt market. As I mentioned earlier, the government came to the debt market for the first time since 2007 in June, placing 15 billion Saudi riyals of 7- and 10-year notes with sophisticated investors, before then going on in August to issue 20 billion Saudi riyals worth of 5-, 7- and 10-year debt to local banks and public institutions. And these sovereign issuances are ongoing. Just yesterday morning, I was seeing the report that the government is in discussions with local banks to allocate the next round of sovereign issuance. And I think it's interesting that we're seeing a slight uptick in the yield on this latest issuance, 2% for the 5-year notes, as opposed to 1.92% for the issuance in August. So that's perhaps a sign that local liquidity is starting to suffer a little bit at the hands of the sovereign issuance program. At this point, I was going to say originally that a market participant recently told me how he was really hoping that the government would tap international markets to prevent local market liquidity suffering too much. But as I'm sure you're all aware, it looks like his dreams have come true. The Financial Times reported last week that this process is now underway, with the government working towards a first quarter 2016 cross-border issuance. And a statement that debt levels could rise to 50% of GDP within 5 years. In reality, I don't think this is that surprising, given the government's need to finance the deficit, but it will mark the first time that Saudi sovereign debt has been available to international investors. And I was speaking to an emerging market fund manager in London just after that report came out, who was kind of visibly excited at the prospect of the cross-border issuance, not just because of the rarity factor, but because he felt that this could really open up the market for issuance from corporates as well as sovereigns, not just in Saudi, but across the entire GCC region by providing a curve and a benchmark. I think it's also worth noting that the government is actively trying to stimulate increased activity in the debt capital markets. The Capital Markets Authority issued its 2015 to 2019 strategic plan earlier this year, as Robert mentioned earlier. And on the debt side, they had the stated intention to improve and facilitate the procedures of sukuk and debt instrument offering and deepen the secondary market. And alongside this, there's also ongoing speculation that following the opening of the Saudi stock exchange to foreign investors, that the debt market may now follow in a similar route in the future. So in the meantime, a chunk of excess liquidity in the bank market has been sucked out as a result of the local bank subscriptions to the sovereign issuance program, as well as the slowing of government bank deposits. And as a result, bank lending is becoming more expensive, and loan growth appears to be slowing. You can see here on the chart, the Saudi interbank rate started to rise just around the same time as the issuance program started, and similarly, loan growth started to slow at a similar kind of point. One Saudi banker I was speaking to said that the market was essentially cautious at the moment. It's taking a wait and see attitude until the budget announcement in December, and that we're really unlikely to see anyone other than highly rated government-related entities coming to the market in the very near term. And also in terms of cross-border issuance now, I think people will be watching out and waiting possibly for the sovereign issuance. But the point regarding bank liquidity shouldn't be overemphasized, though. I think Standard & Poor's said Saudi Arabia's highly liquid banking system is ready to accommodate sizable government issuance in case of sustained low oil prices, and it won't significantly affect banks' capitalization. And I think this is kind of borne out by the fact that discussions we've been having with market sources are saying on the Saudi electricity company planned revolving credit facility that's being discussed at the moment, that international banks are actually struggling to participate in this facility in the face of really quite aggressive pricing being offered by the local banks, which would suggest that there's still kind of plenty of juice left in the system. So just to conclude and hopefully come away on a positive note, despite the oil price slide and the downgrade, looking to the future, the environment seems, to my mind, to be ripe for a pickup in the bond and sukuk market. A benchmark created by a cross-border sovereign issuance, a tightening loan market from the perspective of government-related entities, less ability to rely on state money, all suggest that we may see DCM rising in Saudi and origination bankers' work cut out for them. So I hope that's given a kind of fair summary of how the market stands. Please, if you do have any questions, feel free to get in touch with me on the email address on the slide, or come up to me at the networking session at the end of the day. I'm more than happy to have a chat. Thank you.